Hey everyone, I wanted to talk a little bit here about how you could look at a tax return and use it to open up a conversation with a client that may lead to doing tax planning for them year after year to get ready for future higher tax rates. Here's a tax return of a retired couple, and you can see that there's no income, there's no business stuff. There's $21,000 in tax exempt interest, $38,000 in dividends. Pension income is pretty handsome at $156K, $22,000 in taxable Social Security benefits, $31,000 in capital gains. So they've got a total of about $238,000 of taxable income. So the first thing I would do to look at this is say, okay, you've got a couple that's in retirement. They're not being forced to take IRA distributions yet, but they've got a lot of taxable interest and qualified dividends. So I would go and look at Schedule B for a moment. And when we look at that $21,000, there's $4,800 from Fidelity. So that's probably bonds. It could be corporates or governments, a bond, mutual fund or whatever. But this is where it's really interesting. There's $16,400 of money market interest. Now, we all know money markets don't pay a great deal. Right now, they're up to about 4 to 5% because of the raising interest rates. But for most of 2023, they probably would have been more like 4%. If you divide the 16,000 by 4%, you can see that there's like $400,000 sitting in a money market account. So this couple's making $250,000 a year almost, and they're saving a lot of it. They're not spending it, and they're not taking anything out of their IRAs yet. Down here on the dividends, $38,000. Dividends pay 3 to 4%. If they're paying 3.8% in dividends, that's $1 million portfolio. So we've got a lot of money sitting in taxable accounts here, and they're apparently saving more than they're spending. So what's going to happen if we go back up to here, what's going to happen when they're starting to take these IRA distributions, and how much is in there? So I'm concerned that, if they've got $1.5 million sitting in taxable savings and they're adding to it, they've probably socked away a lot in their IRAs. And when it comes to minimum distributions on $1 million, that's like 40 grand a year. So it could be 40 to 80 grand a year layered on top of this, and maybe tax rates go up, but even if they don't, it's going to force them into a higher tax bracket. Not only that, if they've got kids that are going to inherit this money eventually, they can't stretch it out over their lifetime. They're going to have to pay taxes on it within 10 years. So it's a bit of a mess here, and all the numbers are right there kind of screaming at us that this is tax planning that needs to be talked about.